As 2022 comes to a close, I want to highlight the three things I'm keeping my eye on as we head into 2023. The first is inflation. Globally, inflation is expected to slow in 2023 due to favorable base year effects, diminished supply chain disruptions, as well as lower commodity prices. Additionally, impacts from central bank policy have started to slow global growth, which will help reduce demand and help bring down inflation. Globally, the IMF is forecasting inflation to slow from 8.8% in 2022 to 6.5% in 2023 and 4.1% by 2024. It should be noted, however, that while inflation will continue to fall in 2023, it will still remain well above most central bank inflation targets. If we look at the U.S. in particular, inflation is expected to fall from 8.1% in 2022 to 3.5% in 2023. Price increases have slowed since June of 2022, when headline inflation peaked at 9%, and has continued to moderate as pandemic-related distortions like chip shortages as they ease. Additionally, energy prices have declined markedly from the summer highs. But while inflation is expected to fall sharply in 2023, it will still remain well above the Fed's target of 2%. As a result, interest rates will continue above the neutral rate for longer, with the neutral rate of interest being the interest rate that neither stimulates or restrains economic growth. Additionally, we need to take into account the strong labor market, which will be an important factor for the path of inflation. This is particularly true as we've seen a shift in consumer spending patterns back to spending on services, which tend to be more labor intensive. In 2022, central banks around the world simultaneously increased interest rates to battle high inflation. To date, there have been a total of 354 central bank decisions, with 339 of those decisions to hike the policy rate. Of those 15 decisions to lower interest rates, 80% of those decisions were taken by three countries: Turkey, China, and Russia. And so we haven't seen this level of synchronicity with central banks in tightening financial conditions over the past 50 years. But I think monetary policy divergence is likely to increase as we head into 2023. A few factors will drive this divergence and potential easing of conditions in some of the countries. And the first is simply timing. Not all central banks started to raise interest rates at the same time. For example, by and large, central banks in Latin America started to tighten policy rates earlier than their North American counterparts. For example, Brazil started to raise its policy rate in April of 2021, while the Fed began tightening in March of 2022, almost a year later, and the ECB began even later in July of 2022. So all else being equal, central banks like Brazil are more likely to reach their terminal interest rate sooner than the developed West, and will be more likely to ease conditions in 2023. The economic outlook is also deteriorating, with the IMF recently lowering their global growth forecasts. With the risk of low growth and potential recession rising, it might cause some central banks to ease financial conditions, particularly those central banks that do not have independence and could be put under political pressure. But on the other end of the spectrum, the central banks most likely to keep financial conditions tight are countries that continue to see demand-side pressures as well as strong labor markets. And finally, the last thing I'm looking at are vulnerable sovereigns. Prior to the pandemic and the Russian invasion of Ukraine, many emerging market economies took advantage of low interest rate and the investors' hunt for higher yields to increase and over-leverage their balance sheets. During the pandemic, many countries took on higher debt loads to help mitigate against the negative economic, health, and social impacts from COVID-19. And before these countries could recover, a second major external shock happened from the Russian-Ukraine conflict, which exacerbated already high food and energy costs. Rising prices on basic goods have necessitated the need in some countries to increase government subsidies to protect the most vulnerable, but also to prevent societal tensions. However, the increased borrowing will put further pressure on debt repayment. And debt has accumulated much faster than during previous recessions, including the global financial crisis. According to the IMF, public debt now accounts to close to 40% of total global debt, and this is the most in almost 6 decades. Higher debt in the face of higher interest rates and slowing economic growth will complicate debt sustainability, particularly if the debt is denominated in US dollars. Many countries have reached out to multinational lenders like the IMF and the World Bank to reach concessional loan agreements. So given this challenging environment, I would expect to continue to see credit downgrades and potential defaults for some of the most vulnerable countries. Additionally, debt restructuring will likely become more frequent in the coming year.